Welcome everyone. Welcome to the Year-End Financial Fitness Seminar. I'm just going to go over just a few housekeeping rules right now. So if you want to take this time to grab food, beverages, this is the time to do it. Just want to say hello to the people joining us on Facebook Live. So we're just going to take a few minutes to get started, and please stay with us. Good evening and welcome to the Year-End Financial Fitness Seminar. My name is Danielle Cook-Ferguson. I am the Senior Marketing Specialist at Congressional Federal Credit Union and today's moderator as well. Congressional Federal provides innovative and affordable financial products and services, education, and community outreach to the Congressional FCU family, which includes the House of Representatives, congressional support offices and functions on Capitol Hill, in addition to affinity and non-affinity select employment groups. Established on July 9, 1953 by just 8 congressional employees with just $40 in deposits, we have grown to over 47,000 members and still counting. Congressional Federal has developed a reputation as a trusted credit union based on its proven track record of reliability to its members. Our presentation today will go a little over an hour, leaving time for questions from the audience as well. And we're also going to be on Facebook Live, so those of you joining us, welcome again. Thank you so much for joining our seminar today. Please feel free to provide any questions that you have in the comments section on the screen. And those of you that are joining us in the room, just raise your hand. Okay. We will be providing these evaluation forms as well. They should be in your folder. They look like this. So these are the seminar evaluation forms. We would love to get your opinion of today's seminar. Those of you joining us online, we will provide all of these handouts to you in email, and also we will provide them as a link on Facebook Live later. So let's get started. Let's welcome our panelists first. So today's presenters are Luis Jara, John Moran, and Joe Musumeci. Luis is a consumer lending manager with over 18 years of experience in the credit union banking industry. He specializes in consumer lending solutions and is committed in helping credit union members meet their lending needs and financial goals. Luis has been managing the consumer lending department of Congressional Federal Credit Union for over 2.5 years. John is a wealth advisor with the Congressional Financial Network and has over 35 years of experience in banking and financial services. He has a bachelor's degree in finance and holds his Series 7, 63, 65, and life and health insurance licenses. He works closely with his clients to fully understand their personal circumstances, their overall financial situations, objectives, risk tolerances, and liquidity needs. Joseph is a CPA and partner at Rolls & Company, LLP. He oversees the firm's tax services and provides auditing and accounting services. In addition to being a member of several industry associations, Joe serves on the State Tax Committee of the Maryland Association of Certified Public Accountants. He has also worked as an internal revenue agent, learning firsthand the nuances of IRS examinations. Let's welcome our panelists. Okay, so let's begin with just an icebreaker question. So since today we are pretty much discussing overall financial situations, we're talking about holiday spending, we're talking about tax planning, and we're also talking about just financial uncertainties. So one of the questions I wanted to ask is, what do you consider being broke? When somebody says I'm broke, what does that mean to you? I think we all have our own definitions of that, right? So you guys give me some answers of when you say you're broke, what does that mean? Or when someone tells you that, what does that mean to you? What do you think?
For me, it's like they have like less than $20 in their
Okay,
bank account.
so it means like broke, like,
Yeah,
okay.
yeah.
Okay. Beverly, did you want to have an answer?
When my bank account look red instead of black, it's supposed to.
Okay, so when it's in the negative, yeah. Did you have an answer as well?
I think it's sort of living check to check.
Mm-hmm, yeah.
I mean, you have enough to cover the resources, or the basics, and that's
Mhm.
pretty much it.
Definitely, yeah. A lot of my friends make fun of me because when I say I'm broke, I usually have a little bit. I have that like safety amount, but I consider that broke. I think of it as kind of like, yeah, as you said, check to check kind of thing. I get nervous if I'm in the negative or $20 left. So I think just with all the holiday spending and stuff that we're going through, these are some wonderful tips that we wanted to share with you and just different ways to kind of just not be broke, you know, for the new year. So we're going to be going over a lot of different strategies as how we can prevent that from happening, okay? So one of the things I wanted to do was kind of just open up with some questions to our panelists. But as I said, I will stop through each section to ask if anyone has any questions, and then they'll be happy to answer them. So one of the questions I have is, we know that the holidays are here and people are buying gifts for their loved ones. So one of the main questions is, how do you do that without breaking the bank?
That's a good question, actually. Thanks, Danielle.
Sure.
So basically, what I consider from my point of view is like a two-step process. Basically, trying to figure out what your budget is, and basically determine the amount of money that you want to set aside. Basically, kind of come up with a range of numbers. For instance, like as low as, from making up a number here, from $100 to $500 to spend, and then basically figure it out from there. And okay, because only you know how much you are going to be spending. Once you set up on that kind of a range, be disciplined, so that you don't go over that budget, or otherwise you're going to be in trouble. You're going to be spending too much money. That's the first step, kind of setting up those rules to a number that is you're comfortable with, basically. The second step is basically kind of figuring out basically who's on your list, your list of people that you're going to be, let's say buying something, a gift or whatever that is, and then just like kind of see, you can assign some numbers, for instance, to each person. It's kind of like a two-step process, basically, the way that I see it. And if you are basically committed and disciplined to that, then you're not going to be, in trouble later.
Luis, I definitely agree. The power of the list is strong. That once you have that overall number and then you've broken things down more specifically on that list, you're approaching those decisions intentionally rather than, gosh, I'm at the mall, I'm at the stores, this looks awesome, Harry or Sally are gonna love these things, but once you've made those decisions, in the calm and sanity of your home rather than the bustle and glitz of the store, you can stick to those.
Yeah, just don't let other people see the list. You don't want them to see you're spending $100 for one person and $2 for the next. So keep that list to yourself. But I think those are great points. So to that note, would you suggest using credit cards or discretionary income? And then can you explain what discretionary income actually is?
Yeah, sure. For instance, you gotta take a look at discretionary income. Basically, what it means is the income that you have after you have already paid your your mortgage, your rent, all the other recurring expenses that you have during the month. Basically, just the bills, the utility bills, and all that stuff. And then what do you have left? Let's say you have let's just making up a number, $300, and that's your discretionary income that you can your fund money, I guess. You can spend it or save it. But once you have that number there, kind of keep that in mind, and then look on the other hand. Okay, I have my credit card. What can I do? Do I use my discretionary income? Do I use my credit cards? Think about the credit card that you have. Are they going to do they pay you back? Basically, do you get points, rewards, cash back? Kind of balance those things, and then you can make a decision, a determination of what's best for you. You can perhaps end up using the credit card if they pay you back, whatever percentage that is, and then you can apply it back with the discretionary income, and you can make your purchases, and at the same time get some points and cash back later.
anything to add to that? Pretty much it, right? Yeah, okay. Okay, great. So my next question is, I mentioned before that I know a lot of you have probably done a little bit of holiday shopping. We took advantage of Black Friday, and then there was Cyber Monday yesterday. So for those of us that already spent a little bit, what are some post-holiday shopping tips to prepare for next year? Things that we can be doing for next year?
Yes, so kind of looking forward to next year, for instance, like if after the holiday shopping hangover that people have, some people with are like, oh my God, I have this bill that I need to pay, I have all these credit cards that I put basically all these purchases. So basically, one of the things that you can do is try to look at the credit card balances that you have and trying to see if you can, let's say, consolidate them into one single personal loan. You can send those out for 60 months, 5 years, basically. It's one option of doing that, doing a personal loan consolidation. So you can, do it that way. One option like that. Another option would be refinancing. Looking at, let's say, if you have an auto loan somewhere else, you can refinance it for a lower rate. Another option as well. If you have all those other bills that you have accumulated, during the holidays, if you have, let's say, an option for a vehicle that you already paid in full and you don't owe any money there, basically, you can take cash out of that, vehicle by taking a loan and just, getting the interest rate of basically an auto loan and just consolidating that into that, that automobile loan, which is you can use it as a free and clear title loan, basically. Another option, other companies will offer credit unions esquiva payments. Can you do a esquiva payment on one of your loans that you have with a credit union? That's also an option available for members. And kind of looking into the future, if you want to plan ahead for 2017, end of the year type of holiday spending, you can open up a holiday account, savings account, where you can put set some money inside there. Start early. Let's say you put $40 every month out of your paycheck if you pay once a month. So then that's by month number 10 you already have like $400, and then that's pretty much your build up some of that pre-holiday spending for next year. So.
Great. Any other tips?
Yeah, the after the holidays, as we all know, we hear a lot about New Year's resolutions, and it's the perfect time to be looking at your finances and reviewing your financial situation. And if you haven't done planning on that, you should. And if you've already done planning in the past, it's a good time to revisit it, so that you try and avoid a situation where you talked about earlier, where you feel like you're broke. One of my main functions is to help you plan for the future, so that you don't feel that way down the road, that you have enough in the appropriate areas. Just a quick example of that. I had a customer who was investing their max in the 401k plan that they had, and the company was matching the first 4%. And it's always a good idea to contribute to the 401k plan if you can, or the TSP. But in her particular case, she also had large credit card balances that she was paying 12% on. So for the new year, what I recommended was let's cut back and only put 4% into the 401k to take advantage of the company match. And then that other money that she was contributing to the 401k, we started earmarking that to pay down credit card debt. If you want to think of that credit card debt as a negative 12% return as an investment, or if you want to compare it to an investment, you'd have to get 12%, after taxes. And we don't have any investments that can guarantee you 12%, but if you pay down that 12% credit card debt, it's like getting a 12% return.
That's an interesting way of looking at it. So I think these are great tips just for us to kind of plan ahead. I think we hear advice here and there, but then when it comes down to it, it's like just spend, spend, spend. So I think this is a great time to kind of just, if you already did some spending, looking now to see what things you can be doing now for next year, and if you haven't, looking into some of these tips that the panelists have discussed. Do we have any questions from the audience so far on the section? Not yet.
Well, sure, I could. Is there a gauge of what percentage amount of your check you should, use to build up the discretionary income?
Oh, yes, a good question. It depends, only you know how much, you know, that is, you know, by basically, kind of putting all the numbers together. You know, you can, on an Excel sheet, for instance, you can, you know, figure out your outgoings, like your, you know, rent or mortgage, bills and things like that. It could be as little as $5, basically. So, and you can set money aside like that, and then you know, at the end of the year, you're looking, okay, well, just, seems like I'm getting a lot of, you know, funds built up. So.
I have a question. I like the point you made about coming up with a number for a range for how much you want to spend for a certain amount. How would you suggest keeping track of that, like an easy way to keep track of that if you are using a credit card? Because that tends to, like, speaking from experience, find like, oh, I have this range, and then it's very easy to lose track with credit cards and like different charges, and that can easily get ahead of you.
Okay. Well, basically, setting up the range, it's going to depend upon only the numbers that you know, what you can basically be comfortable with, and that could also, you know, sometimes include, okay, well, I could spend a little bit from my credit card as well, take a little bit of that, and kind of with my discretionary income, do a combination of both, or if you know, just to kind of balance and see, you know, what those numbers finally are going to be, basically.
Okay.
For me, just to jump in as well, that gets back to the kind of preparation list making aspect to it, whether we're talking about holiday gift shopping or things as simple as grocery shopping, setting up kind of a weekly menu list and building the grocery shopping list from that. That way you can really have control and a gauge ahead of time before you're actually taking the card out at the store and using it, running it through.
Right. Okay.
Yes.
To sort of piggyback on that, does that, when you're considering that range, and particularly when you're using a credit card, should you be factoring in like what the interest is when you're kind of considering that range? Because even though you're spending, let's say you say, I'm gonna spend $200, nothing more, and you spend that $200 on the credit card, but by the time you end up paying it back, so how do you factor that into your calculation, like what you're gonna end up spending on the credit card with the interest?
That's a great question, yeah.
I say don't charge more than you can pay off.
Yeah.
Well, yeah.
You wanna add something?
A lot of that will depend on personal situation and what kind of a credit card balance you typically carry. There could be some folks that are looking to pay off a balance on a particular card month by month and wouldn't be paying interest. But there could be other folks that know I've got so much of a balance, and that's a great point. You want to consider not only should I be considering the dollars I'm spending, but the interest on those dollars as well.
So, yeah, and just to pick up on that and answer, you know, review your statements and see how much you're paying on the credit card. If that's really worth it versus, you know, instead of using the credit card or use discretionary income. So, review that and see what the amounts are there. And if you feel like, okay, you know, this is so much of interest that I'm paying on this credit card, maybe, you know, going back to trying to combine all those and pay them off. If you have, you know, high balances, it would be a good idea, kind of like a good solution of, you know, taking those balances down, and that's, of course, eventually it's going to help with your, you know, it helps with credit and stuff like that.
It's a really good idea too, if you're not doing it already, to start building a monthly budget to keep track of where the money's really going. And that interest payment on credit card debt would be one of the categories that you'd have on there. And it can be a real eye opener when you start to do that and get an idea of where the money's going and maybe where you can cut back on if you need to.
Those are great questions. I think there's a lot of different tips and strategies that we can use, but one thing I'm hearing a lot of is lists, kind of organizing how we're doing the spending. And then there's also things, I call them a friendly credit card. So there are credit cards that, you know, they have like the reward program credit cards, they have the cashback ones. So that can also help as well. I know those are usually helpful because instead of using the cash to buy more things, you can use the cash to actually pay off some of the credit card debt you have. So that's something as well, that to look into. Any more questions about that section? No? Okay, I will move on. All right, so let's move on to our financial uncertainty section. So we really wanted to talk about this section just because there's a lot going on during this time. There's a lot of transition happening on the Hill as well as in other places as well. The year end can kind of just be a difficult time for people. So we wanted to talk about just some great strategies that we can really pick up on how to apply during this, what to apply to for this time of year. So one of the questions I have is, let's take me for instance. So I just went through a major financial loss in my life. So what are some steps first steps you think people should take? This is my first question.
I think it comes to a good point that we were just talking about, is do a budget,
Mm-hmm.
you know, and because you may have to, depending upon the extent of the loss, you may have to prioritize some things where some things, the bills just not going to get paid on time, and so you want to, you know, perform that exercise of a worst case scenario and look at whether there's other assets that can be accessed during that tough time. You know, perhaps a loan, perhaps home equity from the house if you have equity built up into your house or condo, apartment. So that's where I would start.
Yeah, okay. Any other
Subject,
questions?
a thought on the budget process. I know many times folks will be intimidated hearing budgeting and, gosh, I need something fancy, a spreadsheet, something complicated or intricate, and it doesn't need to be the case at all. It can definitely start pretty simple and key off of the most important monthly bills, and it could be something that would really grow month by month, and you realize, hey, I'm paying this as well, or this is something that is recurring, I should budget for that. But I think the important thing is to start that habit, and then it can grow and build from there.
Absolutely. I think a lot of times the misconception is budgeting is for people with money. They go, okay, well, if I had money, then I'd have something to budget. But a lot of times, you know, budgeting, it starts with very, you're raising your hand. But a lot of times budgeting starts with, you know, very little money. You can budget anything. And I mean, we're all living, we're all going through life's situations. So I feel like if you can start saving an account for a newborn, then you can certainly do it for yourself. So I think a lot of times there's that misconception, but budgeting seems to be the right way to go.
Well, I realize that planning to budget is a big thing. Where do I start?
Right.
And how detailed do I get?
Mhm.
And what do I put down? And the easiest way I've always helped our members or clients of mine or myself was, rather than look forward, look back.
Right.
Where am I spending my money?
Mhm.
And that's a real eye-opener. If you go through your checkbook, if you go through your credit card statements, you realize where you spent your money 2 months ago, where you spent your money last month.
Mhm.
Hey, guess what? You now have the categories set up for your future budget.
Right.
You know how often you hit the ATM machine. You know how often you use Uber.
Mhm.
You know how much the cable bill is and when it comes in and when your other bills come in. And then all of a sudden, forecasting your budget going forward, it's less daunting, it's more certain, you're more comfortable with it because you're obviously comfortable with where you spent your money. And now you can make an informed decision.
Exactly. Great points. Any questions so far?
Nothing. With all this transition going on, how can we use common sense instead of being fearful of the uncertainty, no matter who's gonna be in, who's in office?
Well, that's a good question. One of the topics that I discuss with my clients is the certainty of uncertainty, which is to say that we don't know what's going to happen, but usually something does, and we want to plan for it. And so it's important to have some what we call a smart money approach, and have different buckets of money. that are available to handle different things. Obviously, hopefully we're saving towards retirement, but we also need, and this ties into a question of yours earlier about the discretionary spending. Well, one of the first, if you will, buckets of money that you want to fill is that emergency bucket. And that should be something that's short-term and liquid and safe. And the rule of thumb that you generally read is 3 to 6 months of expenses, so that if you did lose a job, that you already built up some protection there for the next 3 to 6 months. If you can, I always like to be more conservative and go on the longer end of that. One question I've heard in the past is what's the difference between a recession and a depression? And the difference is a recession is when your neighbor loses their job, and a depression is when you lose your job. and it really does hit close to home because it does affect you. So the big thing, I think, is to try and plan for those events. It's never too late to start planning. And that's my opinion on that.
Absolutely.
Yeah, I just want to add to that. Just keep it, I guess, simple. Keep it, liquid, basically. Money where it's accessible. That is not, money that is, the interest rates are changing up and down. Just like in a regular savings account, just like a kind of keep it safe. That way. So just to have it accessible.
Thank you.
You have a question?
So, going back to Mr. Myers' point about, creating those emergency buckets, and so to speak, if you are in a situation where, let's say you were living check to check, can you talk a little bit about some strategies as to how you go about creating, even if it's, I don't know, any extra room to put into that bucket?
Yeah, the first thing I think is to really sit down and look at where everything is, where your assets are. Again, coming back to the monthly budget, and seeing if there are places that we can cut back on. If we're spending, $500 a month and eating out at restaurants, maybe we can cut back on that. So it's a real individual thing, and you really got to sit down and look at the specifics. There's no one answer to that other than to just really sit down and start to do it and start to do the planning and see where in your particular situation you might be able to find the availability to start building up that emergency bucket. If that's the first thing we're working on, that's the case.
Great. And then to that note, what are some common mistakes you've seen people make when they go through this financial stress?
I'll take one of the obvious ones, which is denial at first.
Absolutely.
A lot of us today have access to credit cards. We talk about credit cards, and at first, if someone were to lose their job, they might not change their spending habits right away and just start using the credit card, which can really just dig a deeper hole. And so the first thing you want to avoid is denial. You want to face that, and it's time to sit down and do some real planning.
Great. And also, I think financial stress goes both ways too, right? You can gain some money, and then people don't know what to do with that either. So it can also go both ways. It could be a loss, and it can also be a gain. But the stress is just as high for both. So I think, what do they say? More money, more problems. So I think it goes both ways. So my next question is, how should I invest my portfolio, and what should I do with my TSP?
I'll jump in on that one as well. That is a very individual thing. You want to sit down and do that planning, because first off, there is based on what your goals and objectives are. We can do investment planning for you and portfolio analysis and portfolio planning, but also risk tolerance is very big. I can show numbers that maybe you should be investing this way, but if you're not going to sleep at night, well, maybe we got to try and find something else. And I'll give you a true example of that. I have no problem at any given point in time, if I feel it's the right time, I have no problem being 100% in equities on my retirement savings. My mother could not own a stock. It took me a week or so to realize that. She owned a stock once, and I had to tell her, you need to sell that stock because it wasn't going to make a difference in her life. But she wasn't sleeping at night. She would come out every morning and look at the paper to see what Fruit of the Loom did. And so I said, you know, it's a good stock, but you need sleep, so let's sell it and promise me you'll never look back at it. And, I don't think she ever looked back at what it did. It did double in a year, but doesn't mean she could own it. So that's one of the things you have to look at, especially if you're getting closer to retirement. It becomes more important that you've got a retirement plan in place. If you're eligible for Social Security benefits as well, you want to tie into Social Security planning. When should you take Social Security income versus income from, say, a TSP or a 401k? So it's a very individual thing, and if my mom was making too big a mistake by staying out of stocks, I would have held her hand on it and gotten her, you know, into the right allocation. But in that case, it didn't make a difference.
Any questions about that? No? Okay, great. All right, let's move on to our next section, talking about year-end tax planning. So one thing I've found is that a lot of people don't start thinking about taxes until April, and don't think about that all the stuff you can be doing right now ends December 31st, and this is really the time where you can be applying all of those strategies, all of those tips to make sure that you're great for 2017. So let's start talking about some great tips. So how does saving for retirement affect income tax?
This can be a great big topic, the interplay between saving for retirement and income tax. And I think there are two large categories I wanted to make sure we hit on a bit tonight. The first is the idea of making tax-deferred contributions to retirement savings plans. So what we mean by that is participating in a traditional thrift savings plan, TSP account, or 401k, 403b, lots of different varieties, but the general concept is that from your wages that you're earning currently, you're setting some aside to use later in retirement. And as the little governmental encouragement, you won't be taxed on those wages now. You're deferring that tax until you ultimately withdraw that money, ideally after retirement. There are some restrictions that apply, but that's the general gist of when you hear about, maximize those retirement savings, the 401k or the TSP, put away as much as you can. Your current near-term benefit is you're reducing your current taxable income by lowering that taxable wage income. But something else to consider, a different approach, you may have heard a little bit about making after-tax retirement contributions. Maybe the word Roth has come up a bit. I believe there's a Roth version within TSP. I'm not totally familiar with all the mechanics, but there are Roth IRAs as well. And the concept there in general is rather than getting a current tax benefit by deferring tax, you're paying tax on that now. That's going to be included in your wage income. But you're going to get a benefit down the road. You won't pay tax again on that later when you make that withdrawal, again, ideally in retirement. But the great big bonus benefit is all of the earnings on those contributions, you'll never pay tax on them as long as you meet the requirements of the account. So for example, the funds need to be within the account for 5 years, and you would need to be making those withdrawals at what the government has marked as traditional retirement age, so in this case after 59 and a half. So there are restrictions along the way, but those are your two great big avenues that you're thinking about. Gosh, am I looking at the near term and trying to defer tax by lowering my wage income, or am I more concerned about down the road? I'm okay with paying the tax now. I want to set something nice up for me down the road to have something tax-free and grow tax-free.
Great. Any other comments? So my next question is, I talked about this a little bit. So what can be done now, and at the end of the year that can affect this year's income tax? So what can be done between now and the end of the year? There we go, to affect this year's income tax.
A couple of different ways that I think about that topic. So when we say affecting this year's income tax, some people will think about what is my experience going to be when I file those returns in April? Will I need to pay a balance due, or will I be due a refund from federal government or a state government? And that really has to do with the interplay of your withholdings from your wages throughout the year, or any estimated tax payments you made, compared to your tax liability that's actually calculated on your tax returns. So if that tax you paid along the way is greater than your actual tax liability, you've overpaid your taxes and you get a refund. That money is sent back to you. Or just the opposite, if your payments were short of your tax liability on your returns, then you have a balance due when you file those returns, and you were underpaid, you need to settle up with the government agencies. That's kind of one approach to thinking about what's the net out-of-pocket result going to look like. But I think that in a way kind of looks beyond that actual tax calculation. How can I minimize that tax liability? That I think that's where you really have some control. The first answer that I'm starting from, that's really math. It's timing. It's how were my withholdings set up? Was I over withheld? Was I under withheld? And then you settle that on your return. That's kind of straightforward, and you're going to have a pretty good prediction of that based on what happened last year. If things haven't really changed and you got refunds last year, you'll probably get refunds this year unless something has changed. Same thing with balances due. If you had balances due, probably have balances due again. But to offer a little bit of a better answer, where we're actually thinking about reducing that tax liability, I think that really harkens back to what we just spoke about in the prior question, those retirement contributions. If you're saying I want to reduce my tax liability for 2016, you have between now and the end of the year to think about, is there anything I can do to maybe put a little bit more into that thrift savings plan, get set aside a little bit more in a tax deferred retirement savings account. That's a great weapon that anyone has to reduce your current tax situation. There are some more intricate strategies that you can start to think about, especially if you're getting beyond standard deduction situation and looking to itemized deductions. Then you have things like charitable contributions and timing of mortgage payments and state income tax payments that can get more complicated, but you could have some different options there.
Absolutely. But I know there's a lot of different strategies for just things that we can be doing at the end of the year. You mentioned charitable contributions. I think that's something so simple, right? Just giving clothing to the needy. That's something. Something as looking into, you can also look into kind of just student loans. So if you're, or whatever loan you may have, so auto loans, student loans, those types of things, paying attention to that kind of stuff. So I think there's a lot more control we actually have, but just aren't aware of. So there's plenty of strategies I think that we can definitely look into in terms of what we can be doing now. I know I'm one of those people that do not pay attention to that kind of stuff, and I should. But yeah, a lot of people really don't think about taxes until March or April. They know they need to get it in as quickly as possible, so before April 15th, right? So I think those are definitely things that we can pay attention to and really learn from in terms of what we can be doing going forward.
Danielle, I'll also offer another tip, which is to if you already have investments in non-qualified accounts, those would be taxable accounts, it's a good time to look at whether or not, first of all, it's a good time to make sure you're diversified properly. And if you need to rebalance your allocations and your investments, it's a good time to look at perhaps some tax harvesting. What is tax harvesting? That might be that where you sell one investment that you have a profit in, and you might want to offset it with a sale of another profit investment that you have a loss in, and those profit and loss may offset each other. I'm not the accountant here, but you can also carry forward any extra losses that you have and can't use this tax year. You can use in future tax years, and you can even offset up to $3,000 of losses against earned income. So that's one thing to do, and if you're investing in non-traditional assets, I'll give you one thing to avoid too at this time to watch out for. Sometimes people make the mistake, especially if they're investing on their own, of if you're doing a mutual fund investment in a taxable account at the end of the year, you may run into a situation where you're going to be hit with capital gains on that fund, even though you only just bought the fund. And that's because of the way the accounting works on that. And typically mutual funds will declare taxable gains towards the end of the year in December. So before making any mutual fund purchases, you want to make sure that if that fund is about to declare a capital gain.
Wonderful. And we talked about, we talked about holiday spending, we talked about financial uncertainty. One thing that a lot of people forget to do is with that return, you can always put it back into a savings. A lot of times people forget that you went the entire year without it, so you can probably continue to go without it and put it into a savings where you can actually build on that or apply it to a debt or whatever it may be. But that is your money, and that is money that you, as mentioned, overpaid in the year. So that is something that you can definitely apply to kind of create a better financial situation. So
We certainly do see clients that almost see that as a type of savings account,
Right.
which
Exactly.
in a certain sense we try to discourage because you're not earning interest on that
Right.
overpayment.
Mhm.
The government is, but it's something where you strike that balance.
Absolutely.
One other end of the year idea kind of related in with this that I wanted to make sure we hit on is if you participate in a flexible spending account, whether it's for medical expenses or dependent care expenses, you want to make sure you're keeping an eye to the rules there, that if you have a use or lose balance, that you're working your way to spend through that. And there are a variety of different possibilities when it comes to medical flexible spending. You're not just talking about the major medical procedures. There are all sorts of more common household items that could come into play there and be included, be eligible.
Great points. Any questions so far? No? Okay. I'll move on to my next question. So Beverly, you actually hit on this just a little bit, but in light of the election, we know that change is going to happen. So what are some strategies that we can implement now to prepare for next year's possible tax rates?
Well, I'll touch on a little bit. Most of us, we pay our fair share of income taxes, and I know since Joe's an ex-IRS agent that I always pay mine on time. But it's, on the other hand though, most of us don't purposely overpay on our income taxes, and if we can legally reduce our tax obligation, we may want to do that. So regardless of whether where the tax rates are, whether they go lower or higher, there are some things that we can do to try and reduce our tax obligations, and some of them have obviously been touched on already, such as the qualified money, TSP contributions, etc. But one of the other things that we haven't mentioned is that it might be, and again, as you're looking at your diversification on your investments and looking at your asset allocation, you might want to take advantage of municipal bonds or municipal bond funds to earn some tax-free income. So that's one of the things that you can look at, for the coming year.
Mm-hmm. Great points. Any other comments, questions?
Can you explain how that works, municipal bonds?
Municipal bonds are typically excused from paying federal income tax on the earnings. And some of them, depending, for instance, if you're some bonds in Virginia, if you're a Virginia resident, you'd also be excluded from paying Virginia taxes on those earnings. So on the dividends that the bonds pay.
Okay.
Any other questions? Okay. So I want to keep this interactive and engaging, especially for our Facebook Live people as well. So I wanted to kind of do like a true-false game. So I'm gonna kind of just make a statement, and then you all let's call out. Let's just call out, and you let me know if you believe the statement is true or false. Those joining us on Facebook Live, just type in your answers in the comments section. I want you to be a part of this too. So I'm going to start with this statement. Now I kind of talked about this a little bit already. So only people with debt budget. True or false? Call it out.
False.
False. All right. Are we right? False. All right. And we kind of talked
talked about why that's false, right? It doesn't matter how much money you have. Honestly, you should be budgeting from day one, some form of it. It doesn't have to be this intricate, Excel spreadsheet of something. But if that's what you want to do, that's fine. But you can start budgeting with as little as you have to the most that you have, and I say pass that knowledge as well. Don't keep it to yourself. Tell people you know. Tell your family members. Let them know that there are different ways of applying these strategies. Anything else?
I would just add to that, it's a lot more fun to budget when you don't have debt.
Right.
It's more enjoyable to figure out where to put that discretionary income each month.
Absolutely. Yeah, I think we spend a little bit more on things that we don't realize. We're prepared for our bills, but when it comes to Uber or food or things like that, we really just don't have a budget for that. I know with Thanksgiving that just passed, I'm pretty sure people went way over budget for buying food. So those are little things that we can think of as well. So good points. All right, next statement. If I get into a bind, I can just borrow on my 401k or wait for a big tax return to pay my bills. True or false? Call it out. You want me to say it again?
False.
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 Okay, false. Yeah, that's not a good way to go, right? But I do know a lot of people that do that. They wait on their tax return and they're like, woo, free money, and they hope that they get a big tax return, and sometimes that's not the case. Also, borrowing on your 401k, there are some penalties with that as well, right? So can we kind of talk about that a little bit?
Sure. I'd say just to start off, if you're taking a loan from your 401k, first we're assuming that your plan allows for that. So there's step one. But if it does, then you'll be paying interest on that loan, and you'll end up paying back more than the amount of that loan over the term. You also need to be mindful of keeping up with the requirements of that loan to avoid having it be reported ultimately as a distribution from your 401k to you, because then it could be subject to withdrawal penalties as well as just income tax on that distribution. So there can be a time and a place where that's the right move to look to that 401k and take a loan, but you need to be careful.
Yeah, you really want to make an educated decision and sit down and look at all the different options that you have. And if that's the one that has to be done, then so be it. But you want to make sure that you're not just jumping at that without having reviewed all the other possibilities, and probably with some help.
Great. Any comments or questions about that? Okay. So the next statement is, I don't need to set a financial goal until I get closer to retirement. False, yeah. But how many people think that's probably true, right? A lot of people wait until they start getting closer to retirement to even start thinking about it. I know a lot of times they say start thinking about it when you're in your teens. Like, don't wait. As soon as you start getting that job, start, right? And a lot of times people wait until much later, closer to their retirement, to even start thinking about it. So why don't we talk about that a little bit? How important is it to really start planning for retirement?
Yes, it's very important, and not just for retirement, but just for your financial well-being and financial future, no matter what age you're at. The sooner you start, the better, and you want to have a plan, and a plan that you can revisit, make sure that you're staying on track for it. If you're getting close to retirement, or you want to make sure that you've done some retirement income planning, it's not just a matter of accumulating assets over your lifetime. Now you're at the more critical point sometimes, is now you have to start distributing assets from your retirement plans and Social Security and things like that. And you want to have a plan to do that and make sure that you're taking it from the most opportune place. For instance, a lot of people would defer taking from IRAs and 401ks until they have to, at age 70 and a half. If they don't have to take it out before, they'll delay that. But at the same time, they might take Social Security early, at full retirement age. not realizing that maybe that's not the best strategy. You know, if you delay Social Security from full retirement age to age 70, you're growing that benefit by 8% a year, plus cost of living adjustments each year. And that's going to be a basis for your future lifetime on those Social Security benefits. And can become even more important if it's a spousal situation, because with one spouse predeceases the other, the survivor gets to take the highest Social Security benefit, assuming that we're both getting Social Security. And so it can make sense to try and build up at least one of the spouse's Social Security benefit by waiting till age 70, if you can. And one of the strategies to do that might be to take money out of a 401k at age 66 or full retirement age instead of taking it out of Social Security. One way to look at that is we talked about debt before, and how if you have a 12% interest rate on credit card debt, that if you pay that credit card debt off, that's like getting a 12% guaranteed return, no risk on investments. Well, with Social Security, if you let that benefit grow from full retirement age to age 70, that's getting over 8% a year with no risk and guaranteed. And you can't get 8% guaranteed, no risk on investment. And so it's a good way to look at that. Does that mean you should do that? No, it's an individual situation. You want to sit down with someone, do some retirement income planning if you're getting close to that age. You know, some people take Social Security early. They don't take it at full retirement age. They might take it at age 62. If they're taking it because they have to, that's one thing. But you want to at least make educated decisions. Again, you want to sit down and do the planning. Maybe they just didn't realize that it might have been better for them to have waited past 62. A lot of people that take it early are doing it because they just really haven't done the analysis and aren't making an educated decision. So with a lot of these things, that's what you want to make sure that you're doing, is that you're making an educated decision. If you're younger and investing for the future, you want to make sure that you have the smart money approach, which is we touched on a little bit, building the different buckets of money. You've got your short-term bucket, which would be used for emergencies, and we want that to be safe and liquid. And then you have your longer term, which would be for retirement, or for saving for something 10 years down the road. Maybe you're saving for a vacation home, something like that. And then you have the intermediate bucket. And basically, the longer the time frame for your particular bucket of money, the more it would generally make sense to be more aggressive in your portfolio allocation. Again, it's a personal thing. You want to sit down and work with someone on that to develop an asset allocation plan, an investment plan, and retirement income plan. The other thing that we touched on a little bit was preparing for the certainty of uncertainty. And along those lines, you want to make sure, especially as you get closer to retirement, what about long-term care expenses? You know, do you have a long-term care policy? Do you need one? Long-term care policies are getting more expensive. And what I would suggest to you that not to let that keep you from at least looking at one. Everyone is getting closer to retirement should at least look at a long-term care plan and what it might cost. The other thing to keep in mind is you still might want life insurance, and obviously if you're younger and have children or beneficiaries that are important and would miss your income, again, planning for the certainty of uncertainty, you want to make sure you have proper life insurance coverage. And even in retirement, you may want life insurance coverage, especially if you can't get long-term care or have decided to self-insure, but still may want to leave something for your beneficiaries. Interesting thing, long-term care insurance is getting more expensive because people are living longer. But on the flip side, life insurance is getting a lot less expensive because people are living longer. So, you know, you may be able to get some insurance that still might leave something for your beneficiaries if your assets are eaten up, say, for instance, in a nursing home. So it's all, the big thing is to sit down, do the planning, and make educated decisions.
I just wanted to add to that, you were talking about the other component of basically, you know, planning for the future is just like looking at your, you know, credit card statements and see what the interest rate that you're paying and trying to, you know, reduce those by, you know, consolidating some of those accounts. Then you can, you know, pay them faster basically with a much lower interest rate, you know, personal loan, a home equity loan. and things like that, basically, that would help you in that side.
Great points. Did anyone have any questions? No? Let me ask you a question. So how many of you are traveling for the holidays? Plan on traveling? Anybody? Yes? I plan on traveling a little bit. Anyone plan on traveling for 2017, the entire year? Do you have a budget? No. Yeah, I don't either. I think a lot of times our budget is based off of the price we see, right? We know to do the comparison shopping, but we don't do the work beforehand. So there's little things, even something that small and that easy is something that we can start applying now, and just knowing, I want to travel. Okay, you know you're going to travel in 2017. Start thinking about those things. We talked about credit card debt. We talked about financial uncertainty. We talked about things that you can be doing with your year-end tax planning tips. So their money is there, right? It's really just figuring out how to allocate it and what are the proper strategies you should be implementing to make sure that you're budgeting wisely. And I think that's one of the points I also wanted to talk about. Is I think that there's people budget, right? The question is, are you budgeting wisely, and are you budgeting for the money that the discretionary income that you actually have? So those are a lot of things that I feel like people overlook as well, that you're not actually paying attention to your situation. And I think our panelists kind of touched on that as well. It's really making sure that you're looking at what you have now, not what you plan to have or what you had before, not being in denial, right? And knowing what the situation is at hand, being aware of other people's situations too. So if you have family members, if you have dependents, factoring those things in as well. You might be fine, but their situation may not be. So there's those things to think about as well. We also talked about financial uncertainty being that you could be getting more money. Maybe that's a great situation to be in, but there's also responsibility that comes with that as well. So what do you do if you're getting additional money? What do you do with if you get a bonus? Some of us are lucky enough to have a holiday bonus that you get. I think Joe had some tips on that as well, as to things that you can be doing with your bonus for tax purposes as well. Yeah.
Sure. It's something to consider, particularly if it's a bonus that's arriving right at the end of the year. Mm-hmm. If you are concerned about being under withheld and you want to avoid that balance due with the return, then maybe work with the HR to have a little bit more tax withheld. And yeah, you'll get less cash, but it'll be less of an unpleasant experience come April if you have a smaller balance due or maybe a refund on your tax return. That being said, you don't just want to blindly do that. If you had a great big refund on last year's return and you're having even more withheld, you're just making that refund bigger. You're waiting to get your own money. So it's something where you want to make sure that you're in control of that information and responding accordingly.
Absolutely. And we provided in your folders, you'll find the your financial fitness guide. You'll find these online as well. You'll find we're gonna have a link to all of the handouts that you can see. But Joe provided us with some great tips here on things that you can be applying for year-end tax planning and also for next year as well. Just some tips that we really don't think about until it happens, but these are all things that we can be looking at. I know I learned a lot of stuff, so there's definitely things that we can be doing now. So I wanted to just check to see if anyone had any questions about anything we talked about today. Holiday spending, financial uncertainty, tax planning. Yes. Mm-hmm.
I have a question that goes along the lines of setting aside money for like an emergency fund with the quick, easy, accessible savings account money. And also if you're trying to pay off a loan or a credit card at the same time, if that's even possible, if it's recommended to do that, or really to just try to pay off your debts before you even start to set up the emergency savings account, because you would be losing like money on the interest. What your thoughts are on that?
Yeah, I don't think there's a sure answer to that.
Sure.
Because if you're saving, for instance, for gifts for next year's holiday or for a vacation in the summer, I think it's still important that you try and do that.
Mhm.
So maybe, even though it might not be paying off a 12% credit card debt, you still might want to split up that discretionary income you have, some going towards paying down the credit card debt and some going towards saving for that, whether it's emergency money or for, the vacation, the trip. Don't want to deny yourself too much if you don't have to. So I think that a lot of that will become a personal thing, but I don't know that you necessarily have to deprive yourself and get that, but the sooner you get the credit card debt down, the better.
Mhm.
But that doesn't necessarily mean that 100% of your discretionary money needs to go to that.
And it'll take time until if you have a high balance on your credit cards to see them kind of going down, eventually, and trying to limit and kind of set up a number. Okay, I don't want to actually go over a percentage amount of my limit, trying to stick to that discipline. And if you already built some of the savings in your account for an emergency future that could happen, I wouldn't use all of that and just empty that out and just pay it off. Just kind of leave that, something there just for, because you already built that emergency, savings for
Okay.
something unexpected.
Any other questions? Yep, sure.
Question is for Luis. I piggybacks on the question that was just asked. Pay off debt and save interest, or squirrel money away for emergency. How about is there any kind of borrowing that you can do to set yourself up in case you have an emergency financial need in the future?
Mm-hmm. Okay, well, there are plenty of, I guess, lending solutions as far as borrowing. You can, take on a loan, and basically pay off your high interest credit cards. That way you can, earlier I mentioned the idea of if you have a vehicle that's already been paid off and you don't have any balances, you can use the value that is there as collateral. Basically, let's say your vehicle is worth $10,000, and then you have a credit card bill of $5,000. You can borrow, use your vehicle as collateral and just borrow against it, and then you're actually set with a much lower interest rate versus a personal loan that is unsecured. That's one of the solutions if you happen to be having something fit into a title loan. So.
Or how about a reserve line of credit you may never use if you just have in case you have an emergency in the future?
Yeah, exactly. You can you have a line of credit which could be attached to your checking account or savings, and you have that available. You don't have to actually use it.
Yeah,
Until it's needed.
and the time to do those things is when, for instance, you are employed. If you're worried about losing a job down the road, you want to apply for those lines of credit, even if not planning to access them, but you'll have it available for those unforeseen emergencies that might come up. And of course, it's easier to get credit when you have a job than when you don't. So you want to build these support devices while you can.
Yep. Any other questions, comments? Okay. Well, one thing I wanted to say is, again, I think it's important that we continue to share these tips. And yes, we have our experts here, but you all are experts too. You all have your own situations. You know what works, you know what doesn't. But I think it's always important to kind of just, the tips, but actually apply them. Don't wait. We have the luxury of knowing when certain things are always going to come. We know when April 15th comes around. We know when the year is ending. So really start thinking about those things. We also know travel. We can start budgeting for those things. We know we need to eat, so budget for stuff like that. So there are definitely a lot of things that we can be doing. I think we have more control than we realize, and really just paying attention to those things. With financial uncertainty, again, life happens, and it's really paying attention to those things, not waiting until it actually happens. We know we're going to be going through changes, and it could be something as simply as just moving. A lot of times, maybe your employment is moving to another location, and it's preparing for that. I know there was a time where a lot of companies used to pay relocation expenses. That's not really the case anymore. So it's paying attention to those types of things. What can we do on our end? What things can we control? So I think we kind of went through a lot of great tips today, and we did some true false, so I know you guys are paying attention and learning. So I'm going to just wrap up. I think we'll wrap up a little early today if there aren't any questions, but please feel free to speak with our panelists afterwards as well. I mentioned that we have our evaluation forms that I would love for you all to fill out. And this is actually our last seminar of the 2016 year. So please stay tuned and look at our website, because we will be promoting all of our seminars for 2017. But I just want to thank our panelists. So thank you so much for coming. Thank you for sharing your tips and great advice. So thank you so much. So again, I mentioned that we are streaming on Facebook Live, so if you missed any of the presentation today, or you just want to see it over and over again, feel free to go on Facebook Live and also visit our YouTube channel. So I will send all of the links out so you all have access to that, and I'll send out our handouts as well. So if you want to, again, share that information, you'll have access to that. Also, we have on the evaluation form on the bottom, you'll see that there's a consultation request as well. So if you want to take some extra time to talk to some of our panelists, we do have that consultation on there, request on there. So if you want to request a personal consultation to kind of talk about your situations, you're free to do that as well. We have our membership relationship managers outside as well, so if you want to talk to them about becoming a Congressional Federal Credit Union member, please speak with them. They'll be here as long as we are, so please speak with them, and they have their cards as well. We have some additional cards here on the table too. So I just want to thank you all for joining us, and again, please stay tuned on 2017 where we'll have our string of seminars. So thank you so much.
Thank you.
Thank you.
Please feel free to get food, drinks, coffee.